Welcome back to Investing Talk Podcast.
Today we're looking at BigBear.ai.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. And this is, well, it's really a story of strategic transformation.
Transformation, okay.
Yeah, when you look at BigBear.ai, you have to understand that they're actively trying to shed their skin, you could say.
Shed their skin. How so?
Moving away from being just a traditional government contractor and trying to emerge as this high-margin, pure-play, generative AI powerhouse.
That's a great way to frame it, because
Right.
when I first saw the numbers from their Q3 2025 performance, my initial reaction was a little bit of panic.
I'm not surprised.
Revenue came in at $33.1 million.
Yeah.
And the headline there is, well, it's a 20% decline year over year.
Yeah, that's a big number.
In a high-growth sector like AI, you see a drop like that, and you have to ask, what is going wrong here?
And that is exactly the right question. But the answer is all about context. If you just read that one revenue line, you miss the whole strategic pivot management's been executing.
Okay, so there's more to it.
A lot more. The company has been very clear that this decline is due to two key things. First, the inherent lumpiness of the defense space.
Right, the timing of big contracts.
Exactly. It's not like selling consumer goods where things are steady. But the second factor is actually the most important for investors.
Which is?
It was a deliberate, managed decline. They're strategically walking away from some of that low-margin, high-volume legacy work.
So they're taking a hit now on purpose.
On purpose. To free up resources and focus completely on the higher margin stuff, recurring AI and software as a service streams, they're choosing quality over just top-line volume.
A painful but necessary cleanup, it sounds like. And I guess their cost management backs up that story, because they were definitely not sloppy on the expense side.
Not at all. Despite that revenue headwind, they posted a much narrower than expected loss. I mean, analysts were forecasting a GAAP loss of 5 cents per share.
And they came in at?
Just 3 cents. That's a significant beat. It signals real operational discipline, tight control over costs. It shows the business is structurally sound, even while it's pivoting.
That does give me more confidence in their forward guidance then, which they kept steady.
Right. They maintained their full year 2025 revenue guidance between $125 and $140 million. But frankly, the market isn't really looking at 2025 anymore.
No, the narrative is all about what happens next year.
That's where it gets exciting. The consensus among analysts is for a real revenue rebound in 2026, accelerating to about 13% growth. And that's not just organic.
It's being driven by something specific.
By a very specific, very aggressive move they're making right now.
Which brings us perfectly to their competitive edge, and that huge war chest they're sitting on. We have to remember where they operate. AI for defense and national security.
Exactly. This isn't general purpose AI. This is mission-critical, high-stakes technology.
And they've built a real moat in that sector.
They have. It's centered on their proprietary tech, which they call the Conductor OS platform. And for you listening, it's important to understand what this actually is.
Right. It's not just a buzzword.
No. Conductor OS is basically an operating system for predictive analytics, but it's designed to work in these incredibly siloed, secure environments. Think different intelligence agencies or military branches that can't easily share data.
So it connects the dots that humans or older systems just can't see fast enough.
That's it, exactly. It pulls in massive streams of data satellite images, sensor feeds, communications, and uses AI models to predict outcomes, potential security events, way faster than any manual process ever could.
And in defense, that speed is everything.
It is the unique value proposition, and we see proof that it's working. Look at their retention rate. They just secured that contract extension with the U.S. Department of Defense.
A huge vote of confidence. The DoD does not stick with vendors that aren't delivering.
No, they don't. But customer loyalty is one thing. The real secret weapon here, what lets them make that aggressive move we mentioned, is their balance sheet.
Oh, yeah. The financial strength it's pretty incredible.
I mean, their cash position at the end of Q3 2025, they were holding a record $456.6 million.
That is an enormous amount of cash for a company of this size.
It gives them security, but more importantly, it gives them strategic flexibility. And that cash is precisely why they can execute their biggest move yet. Buying Ask Sage for $250 million?
Okay, let's pause there because this is the major catalyst everyone's talking about, right?
It is.
So $250 million that's a lot of money. It's more than half their cash. What makes Ask Sage so special?
It's special for a few reasons. First, they're funding the whole thing from existing cash. No new debt, no stock dilution to finance it. That's just phenomenal capital management.
Smart. So they're not weakening themselves to grow.
Right. And second, Ask Sage isn't just another Gen AI chatbot. It's a platform built specifically for secure government environments.
Ah, so they're not trying to compete with the big public models. They're sticking to their niche.
Precisely. This acquisition immediately speeds up their shift to higher margin recurring software revenue. It gives a cutting-edge interface to their existing predictive analytics. It's the perfect complement to Conductor OS.
So it's a synergy play, accelerating the pivot from government services to government AI software.
You've got it. And that makes their pipeline look even better, especially with the backlog still sitting at a very healthy $376 million.
It's a compelling long-term story. But as we know, the market rarely moves just on the fundamentals. We need to look at the recent price action, which has been, well, volatile.
Volatile is definitely the right word. November was a bit of a roller coaster.
For instance, on November 18th, the stock dropped over 8% during that broader tech sell-off.
Right after it had climbed 17% the week before.
It's like the market can't decide if it's a growth stock or a government contractor.
And that indecision creates movement. And that movement is amplified by all the corporate activity and filings we've been seeing.
Okay, let's break some of those down. Back in August 2025, they filed an S3 ASR automatic shelf registration. What does that actually mean for an ordinary investor?
Think of it as just preparatory paperwork. They're registering up to 65 million shares. It doesn't mean they're selling them tomorrow.
So it's not a definite dilution event.
No. It just means they're putting the documents on the shelf, so if a big opportunity comes up, another acquisition, maybe they can raise cash really quickly without delay.
So it's about flexibility, but it does signal the potential for future dilution.
Which is why investors track it. And on the other side of that, we've also seen some insider activity.
Right, the Form 144 filings. We saw one for, 22,000 shares proposed for sale on November 18th?
Yes. And that's pretty common liquidity activity, executives diversifying. But in a volatile stock, the market always watches those sales closely for any negative signals. So far, the scale seems pretty modest.
And beyond the stock itself, they're also tweaking things internally.
Absolutely. The governance is active. In October, they filed a new executive employment agreement.
Signaling what?
It signals they're getting the right management team aligned and in place to integrate Ask Sage and really execute this pivot. Getting the leadership structure right is paramount before you scale.
All of which makes the next 3 months incredibly important. Let's talk about the key calendar dates, the short-term triggers.
Okay, mark your calendars. First up is December 20th, 2025. That's the window for major ETF rebalances.
So inclusion or exclusion could force big funds to buy or sell massive blocks of shares.
Exactly. It can move the needle on volume and ownership overnight. It's a pure supply-demand trigger.
And then, moving into the new year.
January 9th, 2026. That's when we get the institutional 13F filings.
The moment of truth.
Right. We find out if the big hedge funds and mutual funds were buying during this recent volatility, or if they were selling. Big institutional buying is always a major tailwind for sentiment.
But the most anticipated event has to be the Q4 earnings release. That's around February 10th, 2026.
That date is huge. It'll give us the full year results, and crucially, investors will be tearing apart the details on their cash runway after the Ask Sage deal.
They need to show they still have enough in that war chest to get to profitability without more dilution.
That's the key message they have to deliver. And then, just a few weeks later, they're hosting an Investor Day on February 27th.
And those are rarely just boring presentations.
No, that's the stage for new product announcements, forward commentary. It's their chance to really sell the market on this whole transformation story.
Speaking of the Investor Day, that seems to tie into some of the more, let's say, speculative rumors that are floating around.
The rumor mill is definitely active, especially in the defense tech world. There's a lot of chatter about potential strategic partnerships.
With who?
The big defense contractors, the massive system integrators. A partnership would give BigBear.ai an immediate distribution channel to scale their AI solutions much, much faster.
And the chatter doesn't stop with partnerships. I keep hearing about acquisition interest.
That rumor is recurring,
I know.
and it makes sense. BigBear.ai has that unique, secure moat. For a large-cap AI company, buying them is the easiest way to get a foothold in the lucrative but heavily regulated government intelligence world.
They're a very attractive takeover target.
By design. And the most exciting whisper tying back to that investor day is about the tech itself, an imminent algorithmic breakthrough.
Really?
Yes, there are reports alluding to major product news. If they can announce a significant leap forward in their predictive models that could fundamentally change their valuation overnight, that's pure catalyst potential right there.
Okay, so a lot happening. Let's shift to the technical picture. Despite all this volatility, the underlying chart trend still looks pretty favorable.
Technically, yeah, the picture is still decidedly bullish. The chart has maintained those higher lows and higher highs, which suggests investors are stepping in on the dips.
And it's trading above its moving averages.
Both the 50-day and the 200-day, that's a classic indicator of sustained upward momentum.
So for traders and investors, where are the key levels to watch? The floor and the ceiling.
Support looks very firm around the $5 mark. That's been a psychological floor. And resistance is clustered around 650.
So a breakthrough 650 opens the door to the analyst targets.
Exactly. The consensus target is sitting right around $7. And overall sentiment, from what we can see, is positive. Institutional inflows are increasing, and retail interest is strong.
So we have a compelling story. Strategic pivot, deep war chest, a calendar packed with triggers. But we have to be balanced. What are the primary risks here?
The first one is a thing we started with, revenue volatility. The strategy is good for the long term, but in the near term, the top line is still dependent on those unpredictable government contract timings.
So we should expect more lumpy quarters.
Yes, and the market tends to punish lumpiness, even if the strategy is sound. The second major risk is integration.
With the Ask Sage acquisition.
Right. Integrating any new platform is complex, especially a generative AI system. They have to merge the tech, combine the teams, all while maintaining perfect service for their defense clients. If that stumbles, the 2026 rebound could be delayed.
And that's a huge hurdle in such a sensitive environment. Finally, they can't escape the broader market, can they?
No one can. They operate in a highly regulated sector, and they're still exposed to broader tech volatility. A general market sell-off will drag the stock down, regardless of how well they're executing.
So if we put it all together, the strong balance sheet, the clear shift to high-margin AI, all these catalysts, but balanced against the integration risk and contract lumpiness, where does this stock sit? Is it a short-term trade or a long-term AI play?
You know, I think the unique thing here is that you can really approach it from both angles. For a short-term trader, the calendar is just packed with opportunities. Q4 earnings, the investor day.
Plenty of catalyst to play.
Absolutely. But for the long-term investor, the core business capturing that growing non-negotiable AI budget within national security makes this a very compelling long-term hold. You're investing in a company with a dominant position in a critical, well-funded sector.
A stock that lets you trade the momentum while investing in the moat? That's a powerful combination for any informed investor.